Okay, let's get started, everyone. Once again, welcome to HR360's webinar on understanding FSAs, HSAs, and HRAs. My name is Kylan Johnson. I'm the supervisor of legal content here at HR360. And today my goal is to help you better understand these accounts: health savings accounts, or HSAs, health flexible spending accounts, or FSAs, and health reimbursement arrangements, or HRAs. In today's webinar, we're going to go over a number of different areas related to HSAs, health FSAs, and HRAs, including the benefits of having these types of accounts for both employers and employees, definitions of key terms, rules related to eligibility, contributions, and distributions, and applicable Affordable Care Act requirements. The webinar will then conclude with a brief question and answer session. And once again, I'll remind you, if you have a question, you can submit it using the chat button on your screen. There are two important reasons for an employer to consider offering these types of tax-favored accounts to its employees. First, because they provide tax savings for employees, these accounts can help an employer both attract top talent and improve employee retention. In addition, these accounts offer tax benefits to the employer. An employer's contributions to its employees' HSAs are generally deductible as a business expense. Also, if an FSA or HRA is offered, employers may be able to avoid certain payroll taxes on the amounts employees contribute to their FSAs or on funds reimbursed from an HRA. We'll start with health savings accounts, also known as HSAs. An HSA is a tax-exempt trust or custodial account that an HSA-eligible individual sets up with a qualified HSA trustee to pay for or reimburse certain medical expenses. No permission or authorization from the IRS is necessary to establish an HSA. A qualified HSA trustee can be a bank, an insurance company, or anyone already approved by the IRS to be a trustee. Employees may enjoy several benefits from having an HSA. First, employee contributions to an HSA are either tax deductible or, if made by a salary reduction agreement, pre-tax. Second, contributions employers make to an employee's HSA, including contributions made through a cafeteria plan, are excludable from the employee's gross income and are generally not subject to employment taxes. Third, the interest or other earnings on assets in the HSA are not includable in the employee's gross income while held in the HSA. Fourth, employees can receive tax-free distributions from their HSAs to pay for the qualified medical expenses they incur. And finally, an HSA is portable, meaning that it stays with the employee if he or she changes employers or leaves the workforce. In order for an employee to be eligible for an HSA, he or she must satisfy 4 requirements. First, the employee must be covered under a high-deductible health plan, or ADHP, a term that we will define in a moment. Second, the employee must not be covered under any other health plan that is not an ADHP. Third, the employee must not be enrolled in Medicare. And lastly, the employee will not qualify as an HSA-eligible individual if he or she can be claimed as a dependent on another person's tax return. Now let's define what an ADHP is. An ADHP has a higher annual deductible than a typical health plan and a maximum limit on the sum of the annual deductible and out-of-pocket medical expenses that an individual must pay for covered expenses. Out-of-pocket expenses include co-payments, but do not include premiums. Self-only ADHP coverage is an ADHP covering one person, while family ADHP coverage is an ADHP covering multiple people, typically an eligible employee and his or her spouse and dependents, whether or not they are HSA eligible. In general, for 2018, an ADHP is a plan with a minimum annual deductible of at least $1,350 for self-only coverage or $2,700 for family coverage, and a maximum annual deductible and other out-of-pocket expense limit of $6,650 for self-only coverage or $13,300 for family coverage. These amounts are adjusted annually for inflation. Another great HSA feature is that anyone can contribute to an employee's HSA, including the employee, his or her employer, a combination of both the employee and employer, his or her family members, or any other person on the employee's behalf. However, there are limits on how much can be contributed to an employee's HSA in a calendar year. In general, these limits depend on factors such as the type of ADHP coverage the employee has and his or her age. For 2018, up to $3,450 can be contributed to an employee's HSA if he or she has self-only ADHP coverage, and $6,900 if he or she has family coverage under an ADHP. However, if the eligible employee is 55 years of age or older, his or her contribution limit is increased by $1,000. Employer contributions to an HSA, meanwhile, are subject to one of two rules under IRS regulations. First, if the employer contributions to an HSA are made through a cafeteria plan, these contributions are subject to the Internal Revenue Code Section 125 non-discrimination requirements. To satisfy these requirements, an employer generally must not discriminate in favor of so-called highly compensated individuals and key employees in its HSA contributions. However, contributions that favor lower paid employees aren't prohibited. All employer contributions to HSAs not made through a cafeteria plan are subject to the IRS's comparability rules, which require an employer to make comparable contributions to all comparable participating employees' HSAs. If an employer does not do so, the IRS can assess an excise tax equal to 35% of the amount the employer contributed to all employees' HSAs. As stated in the last slide, if an employer decides to make HSA contributions and such contributions are not made through a cafeteria plan, the employer must make comparable contributions to all comparable participating employees' HSAs. Contributions are comparable if they are either the same amount or are the same percentage of the annual deductible limit under the ADHP covering the employees. Comparable participating employees are covered by the employer's ADHP and are eligible to establish an HSA have the same category of coverage, meaning either self-only or family coverage, and have the same category of employment, such as part-time, full-time, or former employees. Both the Section 125 requirements and comparability rules are very complicated. As a result, employers that contribute to their employees' HSAs should seek the advice of a knowledgeable benefits attorney for specific compliance guidance. When an employee pays qualified medical expenses, a term which we will define in a moment, during the year that are not reimbursed by the employee's ADHP, the employee can ask the trustee of his or her HSA to send a distribution from the HSA, either directly to pay for the expense or for reimbursement of that expense. Notably, these distributions can be used to pay the qualified medical expenses of the employee's spouse and dependents as well. Amounts distributed for expenses that are not qualified medical expenses are includable in the employee's gross income and may be subject to an additional 20% tax. Please note that an employee does not have to take distributions from his or her HSA each year. Instead, amounts remaining in an HSA at the end of a year are generally carried over to the next year. Now let's define the term qualified medical expenses. In general, qualified medical expenses are those expenses paid for quote-unquote medical care as defined by Internal Revenue Code Section 213D. That's Internal Revenue Code Section 213D. Among other things, these include amounts paid for the diagnosis, cure, mitigation, treatment, or prevention of disease, or for the purpose of affecting any structure or function of the body. For more details on qualified medical expenses, please read IRS Publication 502. That's IRS Publication 502. Please note that health insurance premiums are generally not considered qualified medical expenses for HSA purposes, unless the premiums are for qualified long-term care insurance, COBRA coverage, health care coverage while an individual is receiving unemployment, or Medicare and other health coverage for employees 65 years of age or older, other than premiums for a Medicare supplemental policy, such as Medigap. Next, we're going to turn to our discussion of FSAs, but before I do that, I just want to remind everybody that slides on the screen and a recording of this webinar will be sent out by email to you this afternoon. So now let's move on to flexible spending arrangements, commonly known as FSAs. Unlike an HSA, this benefit is established exclusively by the employer, and the employee does not own the account. It allows eligible employees to be reimbursed for medical, dependent care, or adoption assistance expenses. FSAs are typically funded through voluntary salary reduction agreements, meaning that employees elect an amount to be voluntarily withheld from their paychecks. But the employer may also contribute to the FSA. keep in mind that there are several different types of FSAs. Health FSAs, which will be the focus of today's webinar, reimburse employees for qualified medical expenses. It is important to note that for health FSA purposes, the definition of qualified medical expenses is slightly different than how it is defined for HSAs. We will get into this later in the presentation. An employee may enjoy several benefits from having a health FSA. Contributions are generally excluded from an employee's gross income and are not subject to employment taxes. And reimbursements used to pay for qualified medical expenses are not taxed. Lastly, employees can withdraw funds from the health FSA to pay for qualified medical expenses even if the funds have not been placed into the account. Employers generally set the employee eligibility rules for their health FSAs. And health FSAs can be offered in conjunction with other employer-provided benefits as part of a cafeteria plan. However, self-employed persons are not eligible, and IRS rules prohibit health FSAs from discriminating in favor of highly compensated individuals as to eligibility to participate or benefits offered. Employers also must comply with the non-discrimination rules for cafeteria plans regarding highly compensated and key employees. While a health FSA is generally considered a group health plan that is subject to the market reform requirements of the Affordable Care Act, these requirements do not apply to health FSAs that can constitute quote-unquote accepted benefits. Prior ACA guidance clarified how a health FSA would qualify as accepted benefits, which we will discuss in the next slide. In addition, this prior guidance stated that a health FSA that is not offered through a cafeteria plan is subject to the ACA's annual dollar limit prohibition and will fail to comply with that annual dollar limit prohibition. Therefore, in order to meet this requirement, a health FSA must be offered through a cafeteria plan. Health FSAs are considered to provide only accepted benefits if two requirements are satisfied. First, the employer must generally make available traditional group health plan coverage to the employees. Second, the health FSA must generally be structured so that the maximum benefit payable to any participant does not exceed 2 times the participant's salary reduction election for the health FSA for the year. Note that for purposes of this second requirement, unused carryover amounts remaining at the end of a plan year that satisfied the modified use or lose rule, which we will discuss later in this presentation, are not taken into account. The employer, the employee, or both may contribute to a health FSA. As I mentioned earlier, employees contribute to their health FSAs by electing an amount to be voluntarily withheld from their paychecks. However, there are limits on how much can be contributed to an employee's health FSA in a calendar year. In addition to the maximum limits, in order to qualify as an accepted benefit for purposes of the ACA, There are also statutory limits on how much an employee can contribute to his or her health FSA for the year. Specifically, for 2018, salary reduction contributions to a health FSA are limited to $2,650. This amount is adjusted for inflation each year. Finally, a health FSA, to maintain its tax-qualified status, must comply with certain non-discrimination requirements that apply to cafeteria plans under Internal Revenue Code Section 125. For example, there are restrictions on employer contributions for plans that cover highly compensated individuals and key employees. Health FSAs must also comply with the non-discrimination rules applicable to other self-insured health plans under Internal Revenue Code Section 105H. Generally, distributions from a health FSA must be paid only to reimburse an employee, his or her spouse or dependents, or the employee's adult children under age 27 at the end of the tax year for qualified medical expenses they incurred during the period of coverage. As we touched on earlier, employees must be allowed to receive the maximum amount of reimbursement, meaning the amount he or she has elected to contribute for the year at any time during the coverage period, regardless of the amount the employee has actually contributed at that time. However, employees must substantiate all of their health FSA expenses. In general, a health FSA can be used to pay all medical expenses provided for under Internal Revenue Code Section 213B, which we went over earlier. However, a health FSA cannot be used to pay for health insurance premiums, long-term care coverage, or expenses that were covered under another health plan. What happens if unused amounts remain in an employee's health FSA at the end of the plan year? Well, an employer can provide employees with one of three different options regarding these amounts. One is that any unused funds remaining in the employee's health FSA by the end of the plan year are forfeited. This is commonly referred to as the use or lose rule. A second option, commonly referred to as the modified use or lose rule, is that up to $500 of unused funds remaining in the health FSA at the end of the plan year may be carried over to the next plan year. Finally, employees can be granted a grace period of up to 2 months and 15 days after the end of the plan year to use any unused funds from the prior plan year. Employers should note that a health FSA can only provide one of these options. For example, if a health FSA incorporates the $500 carryover provision, it cannot also provide for a grace period. Now we're going to move on to discuss HRAs. Before I do that, once again, I just want to remind everybody that the slides that you're seeing on your screen and a recording of this webinar will be sent out to you by email this afternoon. So let's move on to health reimbursement arrangements, or HRAs. In an HRA, employees are reimbursed tax-free for qualified medical expenses up to a certain amount for a coverage period. Unlike HSAs and health FSAs, an HRA must be funded solely by an employer. There are three key benefits for employees with HRAs. First, employer contributions are excluded from gross income and are not subject to employment taxes. In addition, reimbursements may be tax-free if the employee pays for qualified medical expenses from the HRA. Lastly, any unused amounts in the HRA can generally be carried over to the next plan year. Employers generally set the employee eligibility rules for their HRAs, subject to certain Affordable Care Act integration requirements, which we'll discuss in the next slide. In addition, self-employed persons are not eligible, and IRS rules prohibit HRAs from discriminating in favor of highly compensated individuals as to eligibility to participate or the benefits offered. Most standalone HRAs and HRAs used for an employee's individual insurance policy premiums do not comply with the ACA. Instead, an HRA generally must be offered in conjunction with an underlying ACA-compliant group health plan. There are some exceptions to the integration rules we just described, though. For example, retiree-only HRAs, HRAs consisting solely of accepted benefits like dental or vision benefits, and qualified small employer HRAs, also known as QSARAs, do not have to be integrated with an underlying ACA-compliant group health plan in order to be offered to an employee. So what are QSARAs? Eligible employers can use these arrangements to reimburse employees and their family members for qualified medical expenses, including individual health insurance premiums, without running afoul of the ACA requirements. To qualify as a QSARA, first, the arrangement generally must be funded solely by an eligible employer without salary reduction contributions from the employee. The arrangement also must provide, after an eligible employee provides proof of minimum essential coverage, payment or reimbursement of qualified medical expenses incurred by the employee or his or her family members, including individual health insurance premiums. A QSARA must also limit annual payments and reimbursements of $5,050 per employee or $10,250 per family for 2018. Please note, however, that these amounts are adjusted annually for inflation and are prorated where coverage is less than the entire year. Finally, the QSARA must be provided on the same terms to all eligible employees. Employers with fewer than 50 full-time employees, including full-time equivalent employees, that do not offer a group health plan to any of its employees can sponsor a QSARA. However, applicable large employers under the ACA's pay-or-play regulations and employers who do indeed offer a group health plan cannot offer a QSARA. The law defines an eligible employee as any employee of an eligible employer. Employers may, however, exclude certain employees listed on this slide from QSARA eligibility. Note that these exclusions are not required, but are simply permitted under the law. Let's get back to our discussion of HRAs, specifically the contribution rules that apply. Unlike HSAs and health FSAs, only the employer may contribute to an HRA, and there is generally no limit on the amount of money an employer may contribute, with the exception of the QSARA limits we previously discussed. Finally, employer contributions cannot discriminate in favor of highly compensated individuals pursuant to Internal Revenue Code Section 105H. Reimbursements under an HRA can only be made on a tax-free basis for qualified medical expenses to current and former employees, spouses and dependents of these employees, and to the employee's adult children under age 27 as of the end of the taxable year. Like a health FSA, an employer can provide its employees with debit cards, credit cards, and stored value cards to reimburse HRA participants. Employees will, however, be required to substantiate their reimbursement claims. Similar to HSAs and health FSAs, the term qualified medical expenses is generally defined as those expenses paid for medical care under Internal Revenue Code Section 213D, which includes amounts paid for the diagnosis, cure, mitigation, treatment, or prevention of disease, or for purpose of affecting any structure or function of the body. For purposes of HRA reimbursement, however, the term also includes amounts paid for long-term care coverage and amounts not covered under another health plan. Now I'm going to take a few questions that have come in here through the chat function. First question is, what happens to an employee's HSA, HRA, or health FSA if he or she is terminated? But this relates to a concept known as portability, meaning whether or not employees can take the accounts with them once they leave employment. HSAs are portable since the employee is the owner of the account. This means it stays with the employee even if he or she changes employers or leaves the workforce. However, health FSAs and HRAs are not portable. Second question that's come in is, are these tax-favored accounts, meaning the HSAs, health FSAs, and HRAs, subject to COBRA? Well, HSAs are not subject to the COBRA continuation coverage requirements. In general, health FSAs and HRAs are, although health FSAs that meet certain conditions may provide COBRA continuation coverage on a more limited basis. Another question that's come in is, have the 2019 HSA contribution limits been set yet? And the answer is yes. Just last week, I believe, the 2019 HSA contribution limit was announced to be $3,500 for those with self-only coverage under an ADHP and $7,000 for those with family coverage. One question that's also come in here is, what would you say is the main difference between an HSA and an HRA? And the main difference there is that the employee can contribute to the HSA but cannot contribute to the HRA. Only the employer can contribute to the HRA. Another question had to deal with the difference between HSAs and FSAs, and the main difference there, both qualify for cafeteria plan coverage, but an HSA, you can only have an HSA if you are under a high deductible health plan or ADHP, and only certain health plans satisfy those requirements. And FSA is a much more broadly offered, or could be much more broadly offered benefit because it can be applied to any ACA compliant plan, not just ADHPs. Also, another question that's come in is, what about the 2019 FSA limits? And unfortunately, those have not been provided yet. We expect those to be coming sometime later on in this year. By happenstance, it seems to come at different times throughout the year, depending on the year, but those will be coming out before the end of the year, but are not yet available. And the final question I'll take here is, will you provide a printable copy of the slideshow? Well, as I've said before, the slides that you've seen on your screen and a recording will be sent of this webinar will be sent out to you by email this afternoon.